The fundamentals still support a bull market, but brace yourself for volatility. Scott Chronert, Citigroup U.S. equity strategist, joins us now. So, Scott, your confidence hasn't been shaken by all the tariff news and the uncertainty and the worries about the economy?
Well, I think our call going into this year to expect volatility to start the year certainly is playing out, Sarah. I think there's no question that we're in this maximum period of uncertainty regarding policy impacts. I think from our perch, we expected this going into the year. How it was exactly going to play out has been very difficult to dial in. But I still think, the underlying premise here that the S&P 500 fundamentals are in good shape, probably at risk of seeing some negative revisions into the Q1 reporting period. But we still think that structurally under the surface, things are in pretty good in pretty good stead in terms of how we're thinking about the setup going into the balance of this year.
Some people are worried that we're about to get a lot of earnings revisions downward because as the tariffs get clarified, that will just increase costs. It will hurt margins, ultimately could hurt revenues as well.
Right.
Why is that not a big risk factor for you?
Well, I think it is, but what you have to acknowledge or have to at least consider is that the market at the stock-specific level has been trying to price a lot of this in. And it's that, pricing in this uncertainty. I want to keep coming back to that. And so I think what we're going to find as we go into the Q1 reporting period, more C-suites will probably give the analysts a little bit better, sense of where they see the tariff impacts coming. We're going to find out pretty quickly whether the stocks are already discounting that or not. And I think it's going to vary according to the single stock setup. But, what I would emphasize here is that while we've been looking at this roughly 10% or so pullback from that Feb 19 low to last week's near 5,500 level, that's roughly a 10% pullback for the aggregate S&P. But under the surface, the Mag 7 mega cap growth cohort has pulled back 20% plus. There you've alleviated more of the valuation circumstance. So the bottom line, the way we see this playing out, is that this growth is defensive theme can become more relevant as we go into the April-May timeframe as we work our way through the reporting period.
So, would you rather be in a stock like Tesla or Palantir, which, on big up days drives the entire market like today, or would you rather be in a consumer staple or a healthcare stock, which have maybe performed better so far this year?
Well, I would say some of both, right? So the way we're looking at this is that we've been talking about a barbell setup for the better part of this year, which is growth, defensives, and some cyclicals. We're overweight healthcare. Still feel very confident with that trade. We've been overweight energy on the cyclical, more contrarian side. That's been playing out pretty well, but we're also overweight communication services, which is going to catch your big internet names. And then on the tech front, we've been advocating the semiconductors, which I think are having a pretty good rebound day today. So all told, where I want to go with this is we really want to be sensitive to where we think we've got best visibility of earnings growth drivers, even if we're hitting an economic rough patch over the next quarter or two.
What if we're hitting an inflation patch? You didn't mention that as a risk, but that sort of lingers out there, especially with the Fed using the word transitory again. Yeah,
I'm going to get caught a little bit more blindsided on this because I really think that when we're looking at the tariff situation, our view for many months now has been this is going to be a bit more of a gross margin issue than an actual inflation issue. I think we're going to find that consumer sentiment is sufficiently weakening here. That's going to be very tough for many corporates to pass through in the targeted tariff added expense. And so what we think happens here is that you're going to find various companies looking to push some of the tariff onto their suppliers, wherever they may be domiciled. I think you're going to try to push some through to the end client, find out pretty quickly that there may not be that much room or it may not be that easy to really push prices through. So ultimately what's going to happen here is you're going to see corporates have to eat some of it in gross margins. Very quickly what they'll be looking for is ways to offset that, whether it's be other cost-cutting endeavors, productivity enhancements, and so forth.